Oh, thank you for watching this video. In this video, I'm going to talk about key financial ratios. Uh, so this one is how to calculate quick ratio in QuickBooks Online. So I'll have a series of videos regarding key financial ratios. So just watch out for those. So what is quick ratio? In this video, I will explain how to calculate quick ratio in QuickBooks Online. So, what is QuickBooks quick ratio? Quick ratio is also known as the acid test in business world. The quick ratio measures whether a company can meet its short-term obligation with assets that can quickly be converted into cash. The ratio is useful for analyzing companies facing financial difficulties or during a slow economy when sales revenue may be hard to come by. It's basically, economies slow down and you're not getting much revenue, but you have some burn rate to run your business. And can you use do you have enough money to run the business for next certain months? So that's why you need to calculate the quick ratio. Okay, the ratio sums the company's cash. It's basically the cash thing, cash, marketable securities, and accounts receivable. uh, the accounts receivable, it has to be not all account types. It's current ones. And if it's like over 1 year old, 12 months, you haven't been able to collect, the customer is not paying, that's then you either need to exclude it or create a doubtful data reserve. And it's basically divided by current liabilities. Like you have vendor bills to pay, you have uh, you know, uh, credit card debts and some other things. So you can just divide by its current liabilities. So these figures can be found on the company's most recent balance sheet. So just run the most recent balance sheet, and you will see all the your current assets, cash, accounts receivable, and if you have inventory, normally inventory excluded from the list of assets, although it's part of current assets, because it can be relied upon. It can be relied upon for a quick conversion to cash. Some inventory is hard to, you have to sell it, convert it. But if you have selling a really good inventory, you can sell it right away. Then you need to consider and include it. It's up to your business. There are many things. You if you are a business manager, you can figure out which one you can easily convert into cash and which you can't. You have to wait for the right market. So if the ratio is one or less, if the company's cash position, including AR, is one or less, the company may need to raise additional funds, from banks, or hope to see improvement in business quickly. So can you raise uh, enough money from bank, or the bank giving money when the economy is slowing down? So that's the focus. That's how you analyze the ratio. Uh, and if you have any, if you leave a comment, if you have a question, and be sure to subscribe to our YouTube channels. Now I'm going to go to QuickBooks Online accounting and show you the balance sheet and analyze a quick ratio. Okay, so now I'm on QuickBooks Online, and you just run the balance sheet report. So here's the balance sheet. So this is like a demo type. In most of the business, it may look totally different, the ratio. Uh, so it's the current assets in here. There's a bank account. Okay, the bank account, you got 744,000, and then you have accounts payable, 600 to 2,000. It's basically this plus this, and accounts payable if it includes certain items, certain bill invoices that customer hasn't paid for over 1 year, and it's kind of doubtful they will ever pay. Then you need to exclude it, and basically create like a bad debts type, so it's basically in this case is 700 plus 600 is like a 1,300, $1.3 million, uh, and an inventory asset got 91,000, which is included. Normally you don't include it, but if it's inventory items that you can call someone and sell it tomorrow, or even within a week, then you should consider including it. Okay, so that's the current asset side, and then on the liability side, okay, and on the liability side, I have certain. I don't have any accounts payable. I don't owe any money to our vendors. So normally you'll have vendor liabilities too, and I owe certain credit cards like American Express and Chase credit card and Discover, and then I owe some money to pay for sales tax, that kind of stuff, and you need to include all those. So it's basically the current liabilities I have, in this balance sheet is $154,000. So as you can see here, it's a 1.3 minus 154. So you have a, more than one. It's a big, you have a huge cash position there, So if your quick ratios, it's a lot better, So basically, 1,300 minus 150. Let's say you have 1.2 million, So with that kind of cash, even if you slow down, you can still maintain your business for a certain time. So this means in this case for the balance sheet, your quick ratio is superb. It's 5 star. It's really great. Normally, in most of the businesses, you will have like if you have 100,000, the on the assets side, current asset side, those two, bank and AR, let's say 100,000, and on the current liability side, it may be, 80,000 or something like that. So in this example, this is the type of business you need to be in, and slow down economy. So if you just sold this to your bank or whoever, your investors, they will realize this is a good business. So that's the focus of this video. Hopefully, it's helpful to understand the balance sheet, analyze the QuickBooks, the quick ratio. Thank you, and be sure to watch other key financial ratios videos coming out. So thank you for watching this again. Bye.